You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody, that music can mean only one thing. It is Interview Tuesday here on the old Options Insider Radio Network. Time for our Options Insider Radio interview program, the program where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name, of course, Mark Longo from the aforementioned network, as well as from the ever exciting, at least we hope so, theoptionsinsider.com. Reminding you, if you like what you hear, not just for our interviews, but for our educational content, the option block, volatility views, all the good stuff that we do here every day on the network. Keep those reviews coming in your platform of choice. We've been doing this for a long time, but there's a tsunami of new people discovering the options world these days. They need a place to turn for reliable content. We're happy to have them turning our way, so keep those reviews coming. Of course, keep those questions coming, too. We do love to hear from you guys. And speaking of hearing from people, let's see who we're going to hear from today. You know, out here on the Options Insider Radio program, we work hard to try to find guests that are compelling and unique, something you're going to be interested in, and also something you're not going to hear just about everywhere else. I think our guests today qualify in both of those regards. I'm pleased to welcome our old friends here, Mr. Bob Krause, the CEO, and Don Schlesinger, the president at Demand Derivatives. Gentlemen, welcome back to our Options Insider Radio program.
Hey, Mark.
Thank you, Mark.
Well, I'm glad to have you guys back. You guys are long-standing friends of the network, dating back to the inception, the launch of Volatility Views, which seems so long ago now. But that show, over its 400th episode. In fact, you guys joined us for a special, probably the last time our listeners heard you, back on our 400th episode spectacular for Volatility Views. But you guys have been very busy in the interim. You know, it's been a pandemic year. People are taking a break, taking it off. Not you guys. You guys have been hard at work launching this new demand derivatives entity with particularly focused on a very interesting thing I think our audience is going to find compelling, a new crowdfunding venture for a new futures exchange and a clearinghouse. Bob, this is unprecedented stuff. We have a lot of new listeners who've joined us since the last time you guys have been on. So catch us up. What are we talking about here? What is this demand derivatives entity? What are you guys crowdfunding?
Yeah, so let's first talk with the crowdfunding. So if you go to demandderivatives.com, there's a link at the top that allows you to go to our crowdfunding page. And the crowdfunding page allows individual investors. You don't have to be an accredited investor. So anybody really can join and be a part of our new exchange. You know, if you were to invest in the CME, you'd be buying in at a $65 billion valuation or so. Ours is much, much less. And hopefully we can get there someday, you know. But the interesting thing is that you would buy shares in the exchange. And we're making it available for a limited time only. And we do have a signed agreement for another investor who wants to fully fund the exchange. So this may be your last opportunity. And so that's the crowdfunding thing. We hope you join us. And the minimum investment is $105. So it's really open to just about anybody if you want to take a flyer and actually buy an option in a way on our success. So we hope that you guys do that. As far as what we're doing, as Mark said, we are starting a new futures exchange and clearinghouse. We're going to try and compete with the big boys. We're not doing cryptos. So there are something like 400 or so crypto exchanges out there. We're not competing in that space. We're going to compete with the traditional futures exchanges. And in the US, that is dominated by the CME. They have about a 91% market share here in the US in futures. ICE has about 8% market share, so that's 99. And then all the other exchanges kind of chop up the 1%. So that's kind of the lay of the land in the US. So kind of just by default, we're going to be going after the CME and ICE. How we're going to do that is by, I guess our, claim to fame or our secret sauce is going to be, we have redesigned the derivative instruments themselves. Now, many of you are probably already thinking of assets. And in fact, many of the executives and the insiders in the business, when I say we've changed the derivative instrument, they start thinking of assets. Okay, so what asset are you going to trade on? No. It's not an asset at all that we're doing. We're changing the instrument. So let me give you an example. The exchanges have two instruments, futures and options, and they place those two instruments on all kinds of assets, right? On gold and crude oil, on corn, euro, S&P, bonds, all kinds of underlying assets. They place those two instruments on there. And what we've done is design 4 new instruments that we're then going to place on all these assets. Now, we're not going to do them all at once, but we will launch in what we think are the top 6 assets to start, and we will, and then try to expand from there. So let me give you a quick rundown of our company. So the parent company is Demand Derivatives. That's what you're going to buy into. The exchange is called Real Demand Board of Trade, or RealBot for short. The clearinghouse is Real Demand Clearing, or Real Clear. We are applying now for our DCM and DCO. In case you don't know what that means, that's our regulatory license to essentially be a futures exchange and a clearinghouse. Our vision is to rival the largest exchanges in the world, and our mission is to save traders from the risk of ruin and the industry from a derivatives-induced contagion. Now, that sounds pretty broad and pretty ambitious, but it really is where we're trying to go. We're trying to protect traders from getting blown out, and we're trying to protect the industry from being blown apart.
What made you decide to go this route? We've seen new exchanges try to come to the fore. They usually go a very traditional path. They go around, they line up suitors, maybe on the order flow providing side, and they try to get these, stakeholders to invest. Maybe they go out and raise some rounds of capital from traditional VCs or banks as well. You guys are doing some of that, but you're also going this non-traditional route of opening the doors out there to your regular mom and pop investor via crowdfunding. What made you want to go this path?
Well, we really want as many traders as possible, right? And so we want some champions out there. And one way to do that is for you guys to have an equity stake. So if we make the minimums low, allowing traders to, get in and buy in, then, and they like it, right? They're going to tell all their friends and they're going to say, hey, this is really great. And not only that, they would be rewarded because if we get more of their friends and their friends' friends, et cetera, to trade, and the more people that trade, the more valuable our exchange is and the more success we run. So, it's great to get, Morgan Stanley and Citibank and whatever to invest in your exchange, and they could provide a lot of volume and stuff like that. But we really want a whole bunch of champions out there. So we'd like to get a whole bunch of, $100 investors.
That certainly makes a lot of sense. And, spoiler alert, listeners, we think this is a very interesting campaign. We have participated in it ourselves. So we're not just bringing you filler here on the network. I think this is something that's interesting and compelling, and certainly to my mind unique. I've never seen a crowd-funded exchange opportunity before. So certainly interesting stuff. Now, Bob and Don, our listeners from maybe a little bit farther back, probably remember you guys from the Volex days. And of course, the realized volatility instruments that you guys pioneered out there. But what you're doing now is a separate initiative. We should probably clarify that. So give us a quick overview, the elevator pitch, if you will, of kind of the real vol indices and what that real vol product line is all about.
Yes, so I'll let Don explain our products or our instruments, right? The 4 instruments that we're talking about. He can quickly go over what each one does, and then I'll come back and we'll talk more about the exchange and the business model and how we're going to put it all together.
So we should start, Mark, with the product that you mentioned, and that was our flagship product to begin with, and that is Real Vol. This is simply a realized volatility contract, but the VIX trade on implied volatility, kind of settling to a forecast of a future value, a forecast of a forecast. The Real Vol concept is to trade on a formula-driven, calculated, actual realized volatility of the underlying. So you'll be reckoning daily closes. You'll be calculating a 21-day realized volatility, and you will settle to that 21-day realized volatility. The second product is Real Day, and we're very excited about that because, as everybody knows, the trend has been to shortening the period or duration of options. We've taken the concept to the natural next step, and we have created what are actual forward starting or delayed strike options that actually are alive, if you will, for one single day. So you can buy them as much as 2 weeks in advance, but they actually are struck the night before they become live. So if you wanted to target a particular event, such as the election, of course, such as a Fed meeting, such as any type of earnings announcement for an underlying, and they will be struck the night before upon the close. So you will actually know the strike price the day before the contract becomes live, and then it trades exactly like a regular option for the 1 day period that will follow that prior close and striking. So these are real day options. The third product is Real Globe, and this is something that kind of on the back burner. As Bob mentioned, the products won't all be rolled out at the same time. This one takes a little more in terms of development, but the concept is to be able to trade world indices, global indices, with a centralized possibility of greatly streamlining the currency problems that exist when you're trading internationally, time differences, the ability to standardize and trade practically 24/7. So that's the third product. And the fourth, which is really both a product and a concept, is what we call Real Limit, or limits applied to the underlying futures contract. This is the first time ever in terms of innovation that an exchange has ever proposed to trade futures contracts on underlying assets by applying limits both up and down with collateral that will be posted. Each contract is fully collateralized. The whole concept of variation margin or changes or getting margin calls is eliminated. So it is, if you will, a kind of a very hard stop where you can't blow through a stop order, but where you will be certain to be executed. And of course, you will have the ability to roll those positions, and you will also have a choice of different margin sizes depending not only on volatility of the underlying assets, but also simply your appetite for risk. But because this will be fully collateralized, this is trading in a manner that has never existed before on any listed exchange.
And Bob, same question for you. Obviously, Don just broke down the products for us, but break down kind of the structure of the exchange and what you guys are doing with these products.
Yeah, so our technology is already done. We just need to install it. The servers will be in Aurora, Illinois, and Secaucus, New Jersey. We have an agreement with ICE Data Services to distribute our trade data. So everybody who receives ICE data can get our data, which is just about everybody. Our indices are being distributed on Bloomberg and Quandl. Quandl's a NASDAQ company. And we're talking to ICE about distributing our index data as well. So our costs or our fees are expected to be 50 to 90% less than typical futures exchanges. So that could save you a lot of money in trading. We are negotiating with the futures commission merchants now to try and get them to waive the fees. So that would save you even more. And we are eliminating data fees. If you're connected with any of the exchanges, they generally charge you $50 or $100 or sometimes more for just to see the quotes every month, right? So all in all, we're expecting to be 50 to 90% less as far as costs go. And that all stems from, now, how do we do that, right? How do we get the cost so low? I mean, the CME has great technology, so it really isn't the technology part. It's because we had to revamp the clearinghouse. By having fully collateralized instruments, we can make the process so much simpler. We eliminate the guarantee fund. There's no need for a credit backstop. We eliminate the risk modeling group because there's no need to define the perfect margin level. The customer defines that. We eliminated physical delivery. All of our contracts are cash settled. We eliminated clearing members. There's no need for a guarantor. That's what clearing members do, is make sure that you fulfill your obligation. Well, we have your collateral, so you fulfilled your obligation. So all of these things add to or subtract from, I guess, the costs that we would incur, and we're going to pass on those costs to the trader.
Wait a minute, Bob. You eliminated the physical delivery, so how am I going to get my truck of real day delivered to my house now?
Right. Well, we'll ask Amazon to partner with us on that, so that we could save you even the delivery fee. But anyhow, so how much traction are we getting here? So we've talked to asset managers, pension funds, and hedge funds. They're very interested in our real limit approach. They actually have a fiduciary duty to seek out low cost and low risk providers. We can reduce the risk and we can reduce the cost. They now have a fiduciary duty to trade on our exchange rather than the CME or at ICE. So we have a big competitive advantage there. And we've talked to several market makers who are interested in becoming designated market makers, which means that they have to post quotes according to an agreement that we sign with them. We've talked to a bunch of retail investors who are really interested in this real day product, having a very cheap, simple way to trade options and also real limit because they know going in that they can't lose. I mean, there's a great story that happened, back in March, I guess, with negative oil prices that many of your listeners probably heard about. And there was one trader that made the news, and it was kind of amazing. He had $77,000 in his account, And by the end of the day, he lost $9 million. And so, there's absolutely no way to lose that kind of money on our exchange. If you were all in, the most you could lose on our exchange then is 77,000. Now, obviously, we wouldn't suggest that you trade that way, but that's a far cry from, not only losing the 77, but then losing another 8 million and 900,000 more, right? So it's very risky to trade on a standard futures exchange, but it's also risky for the system, right? The investor that lost 9 million, how is he supposed to pay that, right? He pulls out his pockets and he's like, I'm sorry, I just don't have the money. So who pays? Well, the system pays, right? The brokers, the guarantors, the clearing members have to pay. So really the financial system gets stressed in times like that. And so we can avoid or even eliminate really the stress to the financial system. So that's what we're doing, Mark. It's very exciting. If we can raise about 150,000, that's kind of our next target, then we can pay for the DCM DCO application. That's our application with the Commodity Futures Trading Commission to be a futures exchange and clearinghouse. So that's our next step, and that'll also buy us time because that's the longest hurdle. Because we can be ready in about 6 months, installing our technology, ramping up our marketing efforts, getting our IP all squared away, things like that. But it takes about 9 months to get our regulatory license. So we want to get that going and, moving along as fast as possible so we're not wasting time.
Well, speaking of moving along, your crowdfunding campaign seems like it's moving along pretty well. You guys are closing in on that 100,000 level already. I see we have some listeners who tuned in late to the live stream. They're asking where they can find out more about this. Pretty easy. DemandDerivatives2Ds.com is the place to go. You'll see that crowdfunding link, a bunch of other links too, and explanatory stuff explaining what we just talked about here with the different products and things in a lot more detail. But let's catch them up, Bob. Where do we stand right now in terms of the campaign, in terms of how people can participate? And you kind of mentioned what you plan to do with the capital, but maybe some other steps beyond the crowdfunding campaign as well you guys have in your sights.
Oh, yeah. So we do have, let's say, offline discussions going, right? So not part of the campaign. We are talking to a retired market maker who just loves the product, but he's just not making markets anymore. His whole company kind of closed down. So, but he is interested in jumping in. We are going back to some of the investment banks and the futures commission merchants and some of the market makers to be strategic partners. So, hopefully they'll jump in. But we also have a venture firm that is interested in funding the whole thing. The why they're not like in tomorrow kind of thing is they're very institutional quality. So we have to go through an audit and an evaluation and a whole third party. They need like top 4 accounting firms for the audit and another top 4 accounting firm for the valuation or appraisal and that kind of thing. So we have to go through all that. That's going to take about 3 months. So we're kind of awaiting on them, but we're not waiting for them, right? So this is your chance. We're trying to get moving as fast as possible. We have signed the agreement with them, so that's pretty much in the bag. We just have to pass their hurdles. But I'm pretty confident that we will, and that will be coming along, let's say, in the next 2-3 months. But until then, we're going full speed ahead trying to raise capital from others. And in fact, we hope that we get lots of, let's say, little investors or retail investors, to be champions and to take part in a part of this. We would like you to be owners, not just traders. But if you don't want to be owners, then come back and trade when we launch.
Definitely. And let me ask you more of a theoretical, a fundamental question, if you will, Bob. You guys, as long as I've known you and Don have been kind of pioneers in this realized volatility space. You want to get out there and you have patents and products all around this core notion of trading the actual volatility that is taking place in the marketplace, as opposed to some esoteric, arcane calculation that incorporates who knows what in the implied space. I'm curious, how did you get down this path? What is it about realized volatility that really speaks to you and has been pretty much the focus of everything you guys have been doing for the better part of the last decade?
Well, let me just say how we started, but I'll have Don kind of explain the difference, why realized vol is so much better. But when this whole thing started, actually back in 1997, which is when the VIX index was launched. Now, the index, not the trading, but the index itself. And that launch came with a white paper about how this whole thing works. And I read it, and to tell you the truth, I was like, oh boy, I don't see that working at all. And that was my initial thought, and I'll be the first to admit it. I was completely wrong. It did take off, but the reason I was skeptical was because implied volatility, the value itself, the value of implied volatility is in essence a forecast of what realized volatility will be. And if you're trading futures on implied vol, then futures contracts is a forecast of the expiration, right? If we're trading, March corn, then we're trying to forecast what the price of corn is in March. It doesn't matter what it is in December, right? It doesn't. Nobody cares. They're focusing on what the expiration price will be. So if we're settling to the VIX index, right, then we are trying to forecast what the index is, but the index is a forecast of what realized is. So we're trying to forecast what the future forecast of all is. It's really kind of an intangible result. It's very difficult for normal traders to understand what that really means. And it's kind of like trying to forecast the weather report as opposed to the weather, So it's a very difficult concept. And so, whether you're trying to, I guess I could give you another analogy, which is, a hurricane, right? Are you trading the cost of hurricane insurance, or are you trading the loss from a hurricane? So those are two very different things, right? The costs for insurance in Florida may be very high because there's a high chance of hurricanes hitting Florida, right? But our contract would say, well, okay, but how much loss was there? So some years you might pay a big premium and there might not be any losses, right? And in other years, a hurricane may come through and devastate Florida, right? So in our case, if you're trading realized vol, it may go close to zero in some years, and it may be really high in other years where that premium or cost of the insurance may be relatively constant. So it's a very, very different animal. So Don, do you have any more to add about realized and implied?
Yeah, a little bit, and I think the listeners would enjoy the quick story. Some people know that the godfather of VIX was Professor Robert Whaley, who was at Duke at the time. And when I was at Morgan Stanley, we went down at the Duke School of Business, and I was in the back of the room when Robert Whaley actually enunciated for the first time the VIX index and the concept. And just as Bob said, I couldn't have been more wrong, but I do have a take on that. The notion of the implied was really, really irritating me And I sat in the back of the room as a spectator. And of course, I never said it out loud, but I can remember to this day that my thought was, why would anyone ever want to trade that? and the thought, of course, was, why would anybody want to trade investors or traders' guesses, forecasts as to what volatility might be in the future instead of trading actual volatility itself? If you want to trade market volatility, trade the volatility of the market, which is something that you calculate.
I like that. There's a certain poetic logic to that. The notion that realized vol was born the same day that VIX was enunciated in public for the first time. I like that. Unfortunately, gentlemen, that music means we're coming up against it here on the program. Before we go, Bob, really quickly, we're still getting a lot of questions in our live stream. People want to know more about the mechanics of the crowdfunding. So maybe go over that with them one more time. They have questions here, like what's the minimum? One of them asking, so if I invest, am I buying shares of demand derivatives at $15 per share? Said, I'm sorry, it's my first time with this sort of thing. We get it. We understand. I guess this is a novel thing. This hasn't really been done before on the exchange side. So he wants to know what that 105 minimum means, what the $15 means. So maybe walk him through all of that one more time really quickly here, Bob. Then if folks want to kick the tires for themselves and see it for themselves, where should they go? What should they do?
Okay, well, first of all, you go to demandderivatives.com and you click on the crowdfunding link at the top, and that'll take you to the crowdfunding page. As the way it works is we cannot sell you shares directly in our exchange. You have to go to a crowdfunding portal, and we chose Net Capital. So they do everything. They collect the money, they register the shares, all of that stuff. But your next question was, do you get shares? Is this like Kickstarter or something? No. You're not getting, a sample product or something like that. You're getting shares in the exchange. Okay, so it's called private equity. You're investing in a private company. These aren't publicly traded shares. You're buying into a private company. So these would be very private shares. So unless we do list publicly or go through an IPO, somebody buys us out or something like that, your shares are illiquid. So keep that in mind. This is not like an option trade where you can get out anytime. The $15 is the price per share right now. So that's where you buy in. You don't get to negotiate. That's it. You take it or leave it. The $105 is the minimum that Net Capital, the portal, allows. So that equates to 7 shares. So that's the minimum you can buy, 7 shares, and it's $105. And let's see. And all of the information about the investment is there. Typically, when you make a private investment, you have to read the shareholders' agreement and things like that, explaining, that these are restricted securities and all of that kind of stuff. So it's a little bit more complex, or probably a lot more complex than just buying shares, publicly traded shares on an exchange. But the benefits could be, they could be generally larger. The risk is higher, because any startup can fail. Any startup can go bankrupt a lot more easily than a going concern or a public company. It'd be very difficult for Google to go bankrupt, right? Because they make so much money. But for a small company like us, the risk is high, but also is the reward. You're getting in at a very low price, and it could be, I can't say, but it could be big someday. So that's that's that. Is there anything else you can think of, Mark, as far as crowdfunding?
No, I think you hit on all the salient points. A lot of people are concerned about that, which is another thing you guys are doing. They're familiar with platforms like Kickstarter, where you get this vague promise of some item at some date in the near future, but there's nothing really binding there. You're not getting a piece of something, whereas you guys are selling shares. $15 a share and $105 is the minimum for that portal, so you have to buy 7. That's pretty much what you need to know in terms of the logistics. Everything else, of course, demandderivatives.com. So check it out before the crowdfunding runs out and they move on to the next tiers of investors out there. But Bob and Don, it's great to have you guys on. Great to see so much interest here from our listeners. Like I said, it's something new. It's something different, something you guys certainly haven't seen before and probably won't see again. So if you're interested, demandderivatives2ds.com is the place to go. And Bob and Don, great to have you guys on. And we'll look forward to checking with you guys again down the road as we continue to hear more about all things demand derivatives, gentlemen.
Oh, thanks so much. Yeah, we're looking forward to being a part of your investors' normal routine.
Thanks very much, Mark. It was a pleasure to be back and always a pleasure to chat with you. Thanks for having us.
We miss Don's unique tones here on our network. We got to get you guys back here. And we still get questions every now and then for Don on VolView. So the memory of him has not faded. That's good. So check him out if you want to learn more for yourselves, listeners. Demand Derivatives. You guys are always asking, what are those guys up to now? This is what they're up to. DemandDerivatives2ds.com is the place to go. And, of course, keep it tuned to us here throughout the week. We do a lot more than just interviews. Education Wednesday coming up tomorrow. Got Options Boot Camp and Options Playbook Radio hitting you a nice double dose. Thursday, we're back again, episode 2 of the Option Block in TWIFO. This week in Futures Options. Actually, I think we're going to have a special for the live listeners, early TWIFO tomorrow on Wednesday. So stay tuned for that. A little bit of a schedule adjusting going on. And, of course, Friday, we're back with Volatility Views all the way back again to next week and next interview Tuesday and another episode of Options Insider Radio.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.